Hello everyone. It is Sunday, August 29th, and this is episode 28 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at last week. All right, you can see that we did have a breach of one of the breach points. It happened to be the top breach point there. Remember last week I said I had no directional bias on which one it was going to be. It just happened to be the upper breach point here. So we crossed that breach point, got right up to the edge of the upper settlement limit, and then pulled back just enough to close within the expected settlement limit. So we had the breach as we predicted, we stayed within the expected settlement limit, and we did not come even close to the lower breach point, lower settlement limit, or the parabolic SAR. In fact, we didn't even come close to that red midline of the Bollinger Band, and which we will talk a little bit more about here later in the show. All right, let's hop over to the moving averages. All right, we have flipped back to bullish on the short-term moving average. If you recall, last week we had gone to neutral on that rating, and now we are back to bullish on all three time frames. All right, let's add here now what we are expecting for next week. So you see the settlement was at 45.06. For next week, we are looking at breach points at 44.56 on the downside and 45.33 with an 81.23% chance of staying within that, of breaching outside of one of those 2 points. And then the expected settlement range is between 43.82 and 45.85 with about 79% odds of staying within that expected range. Parabolic SAR is up now to 42.95, still well outside the expected range, but trailing as it does until the day that we close beneath it, and then that's another story. All right, let's take a look and wrap this up into the relative view. So you can see that everything really spaced out a lot more because we had some pretty big candles last week. So we had a big green candle at the beginning of the week. Then we had a decent red candle followed by another larger green candle. So a lot of price activity, a lot of range shifting here. And so everything kind of just spaced out because of that volatility. Notice that the upper breach point is above the outer edge of the, or the upper edge of the Bollinger Band. So looking at some resistance on the top side, and then I'm looking at the lower breach point, which is actually above the red midline of the Bollinger Band, and that having that magnet effect. So my take on this, if I'm looking at the two breach points and trying to figure out which one my bet is on, I would say the lower breach point, the 44.56. I think we're going to come back down and touch that and breach that point with that magnet effect. I could be wrong. I'm not saying it's a very strong bias, but I think that the lower breach point has better odds of being breached. And then take a look at how the 43.82 lower settlement limit is right in line with that lower Bollinger Band range. I think we're definitely going to stay within that expected settlement range, and we're not going to get even close to that parabolic SAR unless something major happens. All right, if you didn't see that one coming. So in the last couple of weeks, I've focused a lot more on the week by week forecast and the percentages of the breach points and staying within the expected settlement limits and how the numbers really are sound and how the forecasts are accurate and everything's been playing out and hoping that people can take advantage of it. So today I want to actually step back a little bit because in weeks prior, I've actually shown some charts that go well outside of the weekly range and showed you guys monthly charts going back into the 90s, and I want to kind of revisit that today because I want to show you where we're at. Now I'll give you guys a disclaimer. Anybody who is a chartist out there and is really big on technical analysis and mapping out those trend lines how they're supposed to be, please close your eyes or just fast forward, because this chart that I'm pulling up right now is not intended to be a analysis of the chart. It's not supposed to be drawing trend lines exactly, across the highs or the lows, how they're supposed to be. This is just for informational purposes, for graphic representation of what I'm trying to talk about here. All right, so here's the chart. So going back to the dot-com, era where we had the recession there, the bust. So label that as recession, and then the bottom we have what's called an awesome oscillator. Whoever made it obviously thought it was a pretty good oscillator. I like it, but you see the recession, and then we have the pattern of recovery, and then into growth. And then we had the Great Recession, that went down, then into recovery, and then into growth. And you can see that even when we're in recovery and growth mode, right, that oscillator still, has its ebbs and flows, and we go from red to green, but it typically tends to stay above the zero line, right? And so that's where that oscillator goes from being upward, to down. It kind of flips. So during the recovery and growth mode, we are still having ebbs and flows, ups and downs, red and greens. But if you look at where we left off, right? So we have recovery after the Great Recession, then growth, and then look at where we're at now. What in the world is this? And that is not a very analytical question. It's just like intuitive. It's what is going on here? So I just put question marks, because is this, growth 2.0? Is this hyper growth? Is this unsustainable growth? Is this just going from recession to recovery to ridiculousness? I'm not sure. I just look at this, and to me, it just doesn't make sense. As someone that deals with a lot of data, numbers, not just in the market space, but I look at this and I'm like, something just doesn't feel right. So I just figured I'd share this with you guys, because I think that the chart tells a story. And like I said, I'm not getting into the technicals of it and how the trend lines are supposed to be drawn, but just you can see the direction. You see exactly what the red lines mean and what the green lines mean. And then that yellow section is like what's happened since the recovery from COVID, which some would say we're still not even recovered from that. But what is going on up here in this yellow area, the yellow bracketed area, and down where the oscillator is at? Look at that steep incline of nothing but green. We know historically that we're going to get some red thrown in the mix. But what is this? I'll let you guys make up, you have your opinions on that on your own. All right, let's wrap up here with the quote of the week by Mr. Ray Dalio, who we have heard from before on this show, or quoted at least. I'd love to get him on the show, that'd be cool. But to be effective, you must not let your need to be right be more important than your need to find out what is true. And I think that is especially applicable to, traders, because you need to realize that it's not about whether you make money or lose money on the trade. It's not about whether you think that makes you right or wrong. It's about whether or not your trading is leading you closer to the truth. Now, what is the truth? Are we talking objective truth, subjective truth? Are we talking about truth as defined by Facebook? No, we're talking about what is true to you, your trading style, your market, your systems, what is truly working, right? So if you have a fluke, if you make a bad decision or a bad trade and you end up making money, that is not something that's repeatable or that you want to try to repeat. That is not an indication of truth unless you're able to extract from it what you should not do going forward, right? So I think that, again, you separate those two. It's not about being right or being wrong. It's about getting closer to identifying what are those truths that are relevant for you, your market, your strategy, your style, your preferences, risk tolerance, whatever that truth is, right? Not to sound really, I guess, cliche or whatever, but live your truth. Well, in trading, you really kind of do, right? Because if you try to do something that it does not work for you, or impose a system or a trading style that doesn't really mesh well with that market that you're trying to trade, then the truth is that you're probably going to lose money. And then those two align, right? Because if you fail to recognize what is true, then you will be wrong. So I will leave you guys with that. Enjoy the rest of your week, and I will see you guys here next Sunday.